Hi, I'm Benoit Poliquin, and you're watching the third quarter 2022 quarterly review. I'm the founder and one of the portfolio managers here at Exponent Investment Management, and you're watching our long edition with all of the charts on what happened in the past quarter and what we anticipate future quarters will bring. Thank you for watching. This quarter hurt. It was rough for investors. As you walk down the year-to-date numbers or the past 12-month numbers, most numbers are negative except for TSX. It had a slightly positive number this quarter, and it's kind of the cleanest dirty shirt in terms of performance. The US dollar also is up hard. It is up 7% so far this quarter, 9% so far this year in the past 9 months. Bonds, they're also negative, which is really, really, really rare to have such a negative performance on a one-year basis in the bond market. Oil prices had a really, really rough quarter, as did gold, and interest rates spiked. Let's look at the performance attribution. On the left side, the winners for the S&P 500, they were the energy sector by far. Despite having rough oil sectors, or rough oil prices, I should say, we still had quite positive returns. On the negative side of the ledger, some of the best winners of 2020 and 2021, like Netflix, Meta, Nvidia, VF Corp, and Stanley Black & Decker, retail names, COVID names, all had a really, really rough quarter. In Canada, the winner is very much the same, all energy focused. And on the negative side of the ledger, you had previous winners like Bosch, Aurora, and Canopy, which are previous top, and Shopify. These were all used to be some of the best leaders in terms of performance in Canada. There was nowhere to hide. Here we have an example. What we've got here is a portfolio of 60% equity, 40% bonds. Since the beginning of the year, that performance is down 19%. This would be the typical example of a conservative portfolio, if you will, or even a pension fund. So bonds, higher interest rates, have had a dramatic impact on portfolios. So here we have a portfolio of, or effectively the TLT, which is an ETF or exchange traded fund that mimics or mirrors the value or the change in direction of the 20-year bond, U.S. bond issued by the U.S. government. And that is down 30% since the beginning of the year. This is historic in terms of negative returns. Lemonade. Sounds kind of weird, doesn't it? I know. We all know that interest rates upset the economic apple cart. I don't know why I'm talking about fruits that much, but anyway, how did it actually happen? Why are central banks raising rates like they are? Now, managing money is kind of really, you're managing an economy. And I'm going to use the analogy of a lemonade stand to replicate or model an economy, if you will. The problem with managing money, or an economy, I should say, is that the data is terrible. You're always looking backwards. The economy has so many different nooks and crannies, it's really hard to get really good data at the right time. That's why you need really smart, experienced, educated people to do it. The data problem is a discussion for another day. But imagine you're 12 years old and you're running a lemonade stand on a hot July day. The stand, as I said, is the analogy for the economy. Because everyone is hot, thirsty, you're having a good time, and you're making some pretty good money. You're selling your lemonade. So you're squeezing your lemons, you're adding really good water, cold, and you're adding a lot of sugar. When it rains, you don't sell a lot of juice, a lot of lemonade, but when you're hot, you make your money. When it's hot, you make your money. The more money you make, the more likely you're going to have others join in, and maybe, just maybe, humans are gluttons for self-inflicted injuries. So you decide to borrow money from mom and dad, and you open a second lemonade stand, maybe even a third one. Eventually, everyone does that because there's good money in lemonade. So there's too many, you end up with too many lemonade stands. What happens to the prices of lemonade? Well, they fall. So do the profits. And eventually someone can't repay the loans. That scares the bank of mom and dad. So they react by loaning out less money to everyone else because their loan book is what's called suspect. That would be the banking sector. So that's really, I've just described what is a normal economic cycle. Now, what if I introduced a little wrinkle? What if your family doctor, you happen to have one, tells your mom or your dad and your dad that for your safety, you have to stay home for 2 weeks? Well, that furlough gets extended for 2 years, depending on where you live. Maybe it was 2, 4, 6 weeks, but maybe you're still under furlough. Now, most lemonade stands didn't make it. Now, your friends who helped you out have to stay home too, but they take a shine to investing in meme stocks, playing Call of Duty. Maybe there's sports betting. instead of standing out in the sun in July selling your lemonade. Maybe they're even getting allowance from mom and dad to stay home for their safety. Well, that beats the heck out of selling lemonade. So when the doctor says you're good to go and you can come outside and start up your lemonade stand again, well, it turns out everything's more expensive because everybody's doing the same thing. They're all going out buying lemons. They're buying wood for the stand. They're buying bottled water, sugar, you name it. Everything goes up. Then you call up your friends to come back to work and they kind of don't want to. They're kind of taking a shine to working from the basement, trading meme stocks. So there's less, and there's also less people walking around. So a whole host of other rules. You can't sell as many lemonade as your clients. They're not moving around as much. So you've got problems. You're not making as much money and your costs are higher and you have to pay more for labor because you got to get your friends to come out from their basement. At the same time, the government spends a whole bunch of money and hires a great many people. And your lemonade stand, well, for some, you have to sell your lemonade in a tough environment and you have to hire people in a tough environment. And you don't really know the price of anything. That kind of describes 2020 and 2021. If you've talked to anyone that tried to buy a couch, a barbecue, a car, it was just weird. So just like immediately, I would say we're at the end of the second act. So let's look what the rest of the act looks like. Like any good play, you've got villains. We have a few of them for this market. So let's look at the villains in our play, if you will, in our market adventure. First one are interest rates. We know that. We know that they went up fast and they went up hard. Inflation, we also know that went up fast and hard. Labor participation, that's super important. Why does that matter? Well, how people are working, who's employing them have really important ramifications on the economy. Investors, we're going to talk about valuations. Maybe they overdid it, overcooked it, as they say, in terms of paying for a dollar of earnings. Central bankers, finance ministers, and despots, they all had their share in this downturn as well. Let's talk about interest rates for a minute here. This is the U.S. 10-year yield. So this is the yield that investors are getting when they invest in a 10-year U.S. bond issued by the government of the U.S. Right now, it's 3.83, and this chart goes back about 42 months or so. So we can see the COVID plunge, interest rates, central banks getting involved, lowering the interest rates. We were at 50 basis points. And basically, since April, when the U.S., August, when we had sort of a reopening of 2020 in the U.S., the interest rates have been steadily climbing up. If we look at the chart going back 20 years, we see that we're going back to pre-2007. So the great financial crisis is right here. And what we see is that we're right back to right before the great financial crisis, and we are heading, if some pundits are correct, that we're going back to 5% on the 10-year. We were basically at 383 and we peaked at 4. So we're not, most of the damage is done already, one would say, or certainly I would agree, in terms of interest rates. So what happened back here? So we saw sort of the great financial crisis down here, down here, and bonds went down and then up again, and then they continued to go down. What would happen? So what happened is central bank governments issued bonds, and the U.S. Federal Reserve, or the central bank, bought these bonds, and they ended up on their balance sheet. So what's really important out of this chart is to understand that this is the great financial crisis, and then another section, QE2 and 3. And then the central bank trying to get out of the bond business. They kind of did it too quickly. And come back to it, and then we had COVID hit. And again, they're trying to get out of it. So why does that matter? Well, central bankers were effectively the buyers of bonds of last resort. So the more buyers you have, the higher prices go and the lower the rates go. So when central banks decide to get out of the bond business, like the way they did in 2018, sort of pick up in yield. And then when they start getting involved on the buying side, you can see the yields drop. So what we're seeing right now is central banks trying to get out of the bond business. Ergo, rates shoot up. So let's talk about inflation a little bit. These are charts of the US, European, and Canadian inflation numbers. You can see that they hover around 2%, basically going back 10 years or so. We see the downdraft from the COVID shutdown, and then we see slowly an uptick, as I would say, as the economies grow again. Investors are right now worried about this number, which really has gotten, when inflation gets about 4%, 5%, investors and central bankers start to get worried. And that's really what investors are worried about at the moment. The green line is obviously Europe. It's still going up because of energy. This is another example. What are we looking at here? We're looking at the GDP growth. So we're looking at the US GDP, which kind of hovers around averages here, 3.5%. That's kind of the average. Obviously, we have the Great Recession of 2008, 2009. When we have a slowdown, we fall close to 1, close to 0, really. And that's kind of normal. And then we have the COVID shutdown. And then we had this massive reopening, and now we're kind of rolling over as well. And that's clue number one, that maybe these higher interest rates are going to have an impact. I've always argued in the previous video that we were actually in the middle of a recession. We kind of have this run up, and I think it's kind of a double dip situation where the new numbers are going to be negative and continue to be so for a while. And that's what investors, that's what the stock market is pricing in. So inflation is everywhere. The 2% is kind of the target that central banks like to hit. So it's just not a Canada or not just a US phenomena. It's everywhere, especially if you're in a country that is importing energy like the UK or the Netherlands. Inflation is running very hot. And what investors are avoiding, or they want to avoid, and as central banks as well, is really the replay of the mid 70s to late 70s, early 80s of this inflation that would simply not go away. So I'm going to talk about labor for a minute. Why do I really care about labor from an economic standpoint, especially from a stock picking standpoint? Well, labor is super important because we're in a consumer economy. So 70% of consumer activity or economic activity is based somewhere along the line with the consumer. And the consumer is someone that has a job. So the two things that are kind of important to note here, this is a study called the Labor Canadian Participation Rate. So anyone that is over 18 is able-bodied and it can work. Back in the early 2000s, close to 68% of people worked. Now we're down to 64. We obviously have this big drop during COVID, and we're back to 64. So less people are working actively in the economy. That's obviously an economic headwind. Canada is the land of immigrants, and that's a great thing because it's a labor pool that we need to continue to have. And so the challenge is, if 400,000 is kind of the number has been announced as we needing to hit, we've been hovering under the number of 300,000, and this is the sort of COVID plunge in terms of immigration. So the challenge really for Canada, as we have less people working in the economy that are able to, we need to replenish this labor force. If we don't, we will continue to have labor inflation. Now, if you remember, central banks are worried about inflation, but particularly labor inflation. Now, why would we have labor inflation? Well, we have less people working. Okay, that makes sense. We have less immigration. Got that. Okay. But if you try to hire anyone to do anything, it's really tough to find. And so here are 4 charts. I know it's a busy chart, but stay with me. The blue line is the growth of the number of people working. Okay. So obviously, as Canada's population grows, more and more people are working. That's what we want. And then we've got a bit of the COVID plunge here. And then sometimes you get a recession like down here where it flattens lines or curls right in 2009. The white line is healthcare, which is interesting because, there's a narrative out there that's saying that the healthcare spending is down. Well, from an employment perspective, the numbers aren't there. In fact, the employment numbers have followed the overall map or path of overall employment numbers. What has not followed the path is the goods production, so industrial people making things. So we have X number of people working, so 4 million people back in 2009 making widgets. We still are at 4 million people making widgets. So even though Canada's population has gone up, the number of people working in manufacturing, goods producing sectors has not. So that's a bit of a head scratcher. And then the orange line is the number of people working in public sector or public administration, and it's called. And so the challenge here, it's kind of been flat. It really hasn't grown with the same path. But since COVID, the growth in public administration jobs has literally skyrocketed. We've gone from 1 million people, say at the beginning of 2020, to 1,150. So that's basically a significant increase of over 10% in just a few years. So if you're thinking about it, you say, okay, well, labor has gone on this path, but we've had government increase in employment, and maybe that's one of the culprit for labor inflation. So we know governments are hiring, but on the private sector, 50% of CEOs are looking to cut jobs. They haven't done so, they're thinking about it, and 39 have frozen hiring. So what we're seeing is really weird, because I showed you government hiring is up. We have negative GDP print in the US, but we have jobs that are up. It's the first time in economic history where we have negative economic growth, but positive jobs growth. We've had in the past positive growth in the economy and no effect in jobs. This is what we want. This is where we want to be. And obviously we've had negative economies and negative jobs. So perhaps this is a lagging indicator. Let's look at it. When we look at this chart, full-time jobs, they appear to be stalling. So they're not going up at the same rate as they used to be, say in 2021 or especially in 2020. Now, investors, we're a weird bunch. We're really, should say, effectively emotionally unstable. So remember, I will always be saying a cure for high price is high prices or higher prices. So valuation. So here's what we've got. We have the S&P 500, and the yellow line is kind of the price appreciation. So that's the index. And the kind of teal line is what are investors paying in terms of dollar earnings. You can see that when the market sort of turns south, a lot of it sometimes is due just because investors turn bearish and they don't want to pay as much for a dollar of earnings. And when things are really hot, they will overpay, kind of like last year. And ever since then, this was the end of 2020, the beginning of 2021. So the PE ratios, or how expensive the markets were for each dollar of earnings, actually peaked in the first quarter of 2021. And we've been coming down, right back down to the mean in terms of PE ratios at 17.26, which is kind of right in the middle of where we want to be. So from a PE perspective, certainly the market has normalized. So maybe it is because the valuations of 2020 and 2021 were overcooked. Are they overcooked now? It's tough to say. The same story goes here in Canada. Price in yellow moving up and the valuations coming down. Central bankers and finance ministers. So this is a complicated chart, so stay with me. So down here, what I've got, well, maybe we'll do it this way. So what I've got here in the US is the Fed fund rates, the short-term rates that the Federal Reserve sets. We can see that basically in the first quarter of 2022, they went up, and they went up quick. The last time they went up as high was starting back in 2015, and it took basically 4 years to get to that level. We did it in less than 4 quarters. If you go back to 2004, the interest rates went higher, but they started from a higher base, but they also took basically 2 years to peak out. Pundits are calling for 5 to 5.5% terminal rate. Sounds plausible, and we're basically 60% of the way there, and we did it in 3 quarters. This is basically what we're looking at here is the budget deficit, because really the US doesn't run a surplus, as a percentage of the GDP or the size of the economy. So basically you're looking at deficit and they're saying, you know what, it's 2% of the economy in 2006, and it goes down to 10% of the economy, obviously after a recession. Why governments tend to increase spending in recessionary times, and the GDP goes down. So you have a sort of a double effect on the negative side. When the economy turns around, governments come back to their sort of equilibrium, and then we have the COVID plunge, and now we're back to where we wanted to be. The US is back to where they wanted to be sort of pre-COVID. Canada, different story. Here's our short-term rates, same path as the US. In fact, we've done more than the US. But our GDP, our deficit as a percent of GDP, it's terrible. We're down to uncharted territory in terms of minus 12% or 12% of the GDP. The deficit is 12% of the size of the economy, which is a very, very big number. The average being 1.8. So despots, dictators, and politicians are also to blame. Why? Well, On one hand, we had sort of a policy around climate, and it really drove economic change. The idea was that this new way of generating power would generate new jobs, new economy, and all would be well, and we would save the planet in doing so. The flaw in the ointment is that the new, whatever is new, is not quite working at prime efficiency, and there's other layers or other unintended consequences, and there are other layers like geopolitical events. So the issue that we've got here right now, from an energy current perspective in Europe, not only do we have a war that has its seeds 20, 30, 40, 50 years ago, but also we have an energy crunch that is 30 years in the making. So the UK moved hard to green energy, and the issue, and natural gas being the main source, and natural gas coming from Russia. Russia goes to war with Ukraine, as we know, and all of a sudden, the main energy source for Europeans turns out to be their arch enemy. And so natural gas becomes a weapon from a geopolitical perspective. And the alternate producers, if you will, well, for them, it's their budget. And so they're trying to protect high prices by cutting production in order to protect their margins, which is what you would expect out of normal economic behavior. And then we go back to the geopolitical issues of going back of when the wall fell down, the expectations were that the axis would remain, the Soviet axis and the EU axis would remain. However, that did not stand the test of time. So you have political events impacting energy events, which really started when there was a shift from a policy perspective. And we continue to have this issue because from a political perspective, growing the pool of available fossil energy is not palatable, either for those providing capital or those doing the work, where there's just no incentive to do so, either from a stock perspective or just from a regulatory perspective. So let's talk about the current sell-off. This is the usual sort of path of a sell-off. So market goes up, I don't know, so let's call this 2018, 19, 20, and 21, and then we're down, and the sell-offs are always really quick. Not always, but typically very quick. I'll show a chart for that a little later. Here's what I mean. So these are the sell-offs tend to be as short as 4 months. They can be as long as one and a half, let's call it 18 months. We have a long one here, but typically they are of the 1 and 18 month variety. And we are about 9 months, 6 months. This chart is about 3 months old. So we're really in month 9 or 10 of the sell-off. What is also important to remember from this chart is that after, first of all bear market end, and number two, you always reach a new high after the bear market. So I talked a lot about interest rates. Why is everyone talking about interest rates? Because higher rates, or interest rates in general, are the price of money and time. So what do I mean by that? Well, investors, whether you invest in real estate, a bond, a business, or a stock, you want to know what today's value, what it's worth today based on future expectations around the cash flows. Now, a bond's pretty easy because you know what the interest rate, what the posted interest rate will be, but you don't know what the interest rate to discount the future cash flow will be. So what you do is you use, say, the 10-year bond rate. Well, if your 10-year bond rate goes from 0.6 to 3.8, it has a massive difference on your cash flows, especially the cash flows that are out into the future. So think tech stocks, think long bonds, all their cash flows are out further out into the future. And the bigger the R goes up, the more the present value of those cash flows comes down. That's why interest rates matter. The other thing that matters about interest rates, and I'm repeating it for a reason, these interest rates have gone up in an unprecedented way, and it took very, very little time to do. So, but what if it's working? What if all the rise in interest rates, the inflation, this is a Goldman Sachs index that tracks financial conditions. And it tracks whether money is tight, whether it's hard to get money, whether it's hard to get money to grow, whether it's the business or the economy, or whether it's easy. And we can see that we moved from a very easy part, basically in 180 days ago, to where we are today, where it's very tight. So it's been very, very quick. An unintended consequence of this, and this is important, is the rise of the US dollar. So the US dollar is as high as it's been since the depth of COVID, and it's much higher than the Great Recession. I can go back to 2007. So you have to go back to effectively the 90s for a currency to be this, the US dollar to be this high. So it's very, very important to remember. Why does that matter? Well, all commodities are priced in US dollars. So if you're from Germany or South Korea and you're buying you're buying wood or a barrel of oil, well, that's priced in US dollars. So your won or your euro has depreciated 10, 20, 30% against the US dollar, and those commodity prices have doubled. You can see how that creates a massive inflation problem for those countries. So it is certainly it's certainly possible that you would expect those trading partners of the US to start putting political pressure on the US to curtail either the speed or the strength, how quickly and how high interest rates are going to continue to go up. So when you have less money, what do we mean by that? Well, central banks control the flow of money. The more money you have in the system, the more this money starts to generate or chase goods and services. And when the economy is flat on its back because of a shutdown or a recession, central banks will want to pump money in the system to kind of generate economic activity. That is what they're trying to do. And what we can see here is that it's working. There's less money. All the central banks have taken capital out of the economy. We can see that led to, they didn't call it a recession, but I mean, it's too negative GDP growth, which by definition is a recession. The reason why the US didn't call it a recession is there's still positive employment numbers. We covered that already, and we know that those government hirings might be the reasons why the employment numbers were positive. So what if markets are down 25% since the beginning of the year, so prices are marked down 25%. What if the valuation, what investors are trying to pay for a dollar of earnings, are marked down 43%? But the earnings are still banking on a rise in earnings. Well, what if the earnings simply go back to where we were pre-COVID? Well, that would mean that the current stock prices actually make sense. Maybe investors are getting this one right in the sense that they're preloading a future recession in current stock prices, because that's what investors do. They look 3, 6, 9 months down and try to figure out what the right price of the asset is today based on future conditions. So I'm still on the inflation number. Why? Well, I'm trying to convey that maybe inflation, the spike, is behind us, which would allow central banks to curtail their interest rate rise, at least the speed of it. And that might be what we want to see, certainly from a stock investor perspective. So what you're seeing is CPI going up, spiking. This is the latest. So CPI is a consumer price index. It's effectively a basket of goods and services that the average consumer would be buying. In Canada, it's Statistics Canada that keeps it. They all have the same methodology. Basically, it's pretty close. And you've got all sorts of things in there. Let me show you. So you've got food at home, cereal, all sorts of things, all the way down to airline fares. So the idea here is to say, okay, well, why does that matter? Well, all items is 8.2 and the core is 6.5. What does that mean? Well, they're trying to hone in on what are the important factors of the consumer price index, or CPI, that came out. And they do this basically every month. And this is the latest one for September that came out in mid-October. What's important, though, is the weight of everything. So food, for instance, is up 11%, but it makes up 20% of the CPI number. So it's important. Whereas energy makes up 8%. And airline fares make up 0.6%. So they're up hard, but they don't really matter. So food is up, and it's very important. And I'll show you why the rise in food prices is probably behind us. And energy, I just showed you the oil price that is down 24% this quarter. That might also be behind us. So the other important part is of CPI is something called shelter. And shelter is up 6.6%, and it's made up of rent and equivalent of rent, which would mean mortgage payments. Now, if your house is paid off like most of our clients, this doesn't matter to you. But this section here, shelter, right here, that is 33, almost 33% of the CPI. And the input of shelter are actually interest rates. So as interest rates rise, this shelter number goes up because rent numbers go up and because mortgage payments go up. So it's kind of a negative feedback loop when you stop and think about it. Central banks have a direct impact on the CPI numbers, but they're looking at the CPI numbers to make their decisions. So it's important. Don't get me wrong, the central banks understand the weakness of CPI. I'm just trying to explain it to you because when you read the headlines, you want to sort of freak out because you're seeing this number and you're right back thinking 1975. Bell bottoms and wait lines at gas stations. So I kind of let the cat out of the bag and said, I think inflation is behind us. I think it's curling. It's certainly not behind us. But I've got a bunch of charts for you. The first one here that we're seeing is corn. So corn prices, yeah, they're up from 2019, but they're certainly down substantially from where they were back in 2021. Another price for you is lumber. Remember when lumber made all-time highs during COVID? Well, it's right back to where it was pre-COVID. This chart right here, also making headlines back then, was the price of shipping containers going from Shanghai to LA. Well, we're not quite back to pre-COVID, but we're certainly going to get there. This is the price of natural gas. Certainly, we're on an uptrend here. Natural gas in North America is, as it gets higher, it becomes more and more economical to ship to Europe or to Asia. So what happens in Asia and what happens in Europe past a certain level matters, and we're certainly past this level. So natural gas prices in Europe are quite high, so producers now have a financial incentive to export it, to liquefy it, put it on a ship, and export it. Here we have the price of oil. So we know we had the big dip that also made headlines, and we're kind of back to this sort of not pre-COVID level, but we're close. So we know that between $60 and $80 is a sweet spot in terms of producers and in terms of the market, because you don't get into the demand destruction. So it looks like the market wants to get back to equilibrium, doesn't it? And we just had this weird spike as the economy opened up. And finally, what we have here is the price of producers index. So that's the stuff that goes into the stuff. And you can see again that price rolling over. So that's an important cost into how all of our goods are priced. So if the producers have less of an inflation in terms of their input costs, it flows through inflation eventually. So what do market recoveries look like? What do we need? What are the ingredients? So we need a central bank pivot. What does that mean? Well, we need all market bottoms happen when interest rates are stable and predictable. They don't necessarily need to stop. They don't need, to decrease. It certainly helps, but they just need to stop going up. We need low valuations. Well, I've explained that. We're already there. Markets are pretty cheap. The question is, what will earnings look like? We need improving earnings. Again, to my point, you need cheap markets, but also you need sort of an improvement. You don't want to be having earnings decline. You need some sort of geopolitical clarity. You don't necessarily need peace. Markets have gone up during war. There's lots of examples in the past of whether it's the Cold War, the Persian Gulf. Most of these markets, they were up 18 months after the beginning of the hostilities. You need pro-growth political climate. So it's an immutable statement to make that in past 10, maybe even 15 years, pro-growth politics were superseded by a more progressive agenda. The idea of growing the economy and growing paychecks wasn't really top of mind. for both the electorate and the politicians. Like all pendulums, we need that to sway back towards a more pro-growth for really the stock market to really get a move on. And don't forget problem solving. The problems before us are always numerous and they're complicated, but economies have been here before. The fact that you're viewing this from your phone, probably, or your tablet, would have been unthinkable 15 years ago. Innovation and ingenuity. I mean, another example would be, so look at, this is a YouTube usage. There's 2 billion videos back in 2020. I think that number has doubled since then, of videos per month, where this market didn't exist really 14 years ago. Another example I like to give is this first surgery for hip replacement in the late 60s. There was only one, obviously. And then here we are, we're doing, in the US, there's about 450,000 hip replacements. So never underestimate, over the long term, problem-solving mindset. So if you think of a company that has a labor shortage, they will solve it. Innovation and ingenuity. So I've had one client, just one of them, that basically said, well, Ben, okay, why don't we sell? I can't handle this anymore, why don't we sell? Well, there's a lot of problems with that concept. First of all, long-term investing is great, but at the end of the day, we're all dead, or so the saying goes. So it's hard to do. First of all, there are big down days and even in up markets. So that's the one thing to remember. And market declines are kind of normal. So since 1946, we've had 84 number of declines that have taken 5 to 10 months. They take a month to come back, 10 to 20. We've had nearly 29 of them. It took 4 months to come back. Even the 20 to 40%, we've had 9 of those, and 14 months is taken to come back. So obviously what we're trying to do is avoid those big ones. And I'll get into the how in a little bit of a minute. But there's a few things to remember. And most professional portfolio managers adhere to these principles. Now, the first one is you can't predict. So you just accept the fact that you cannot predict. You certainly can tilt. That means you have to shave positions. You're trying to limit some of these down days. You're certainly trying to limit these minus 40% numbers on the portfolio. So what do? You sell when people are buying, you shave position, maybe you cut positions. And the best time to sell is when markets are hot. So you're definitely going to be late at the turn, maybe early. You're going to sell early. You're probably going to be both. Remember that your reasons for outperformance will probably be why you'll underperform at a later date. You need to accept that. So if you're a home run hitter in tough markets like these, you're going to strike out. If you're more of a singles and doubles hitter like we are, or like I am as a portfolio manager, this is your time to shine. You limit your downside, got a lot of cash, you're deploying it. But when markets are hot like 2021, you underperform, and you kind of get a bit of a political heat for it. But that's okay. You need to own it. You want to avoid wholesale and tilted decisions. You want to make your decisions incrementally. And remember, there's only one law in investing that is immutable, and that's there's a reversion to the mean. When something goes too far off one way, it will always revert back to its mean, and sometimes overshoot it to the downside. So here's what I mean by mean reversion. So have you heard it before? Bear markets are opportunity. All right, that's easy to say, but it's really hard to do. What does it even mean? So I've got 2 examples for you. So the first is the ugliest stock in the portfolio, Logitech. You might not recognize the name. They're a dominant player in computer peripherals. So think keyboards, mice, webcams, even virtual reality goggles. They don't have any debt, great margins. Quality management has been doing this forever. In a market that really didn't exist 10, 20 years ago. And as there's more and more different devices, work from home, all of these different things, it's only helping their business. But the stock is unloved. Right now, the stock is selling. So one of the ways we look at a stock is we'll say, okay, what's its mean in terms of valuation? What is typically an investor willing to pay for, say, over the past 5 years in terms of a dollar of earnings, or PE? So the mean is 21.2 times. And we really get excited when we can buy stocks that are one standard deviation below. And when stocks get one standard deviation above their mean, we start thinking about selling them. We not necessarily sell them, but we're thinking about it, we might trim it. So that's what we mean by reversion to the mean. And this is standard for every stock. So right now, no one wants this stock. We bought it in early 2022, basically 50% ago, when it was at one standard deviation, and now it's at 2 standard deviations below what it should be. It's really never traded this cheaply ever in its history. On the other end, we have General Mills, the makers of Cheerios. It's trading, it's never been this expensive. So we bought that stock back in early 2018, and back then General Mills was cheap. We were in the middle of an economic expansion. Narrative was no one eats breakfast anymore. They all go to the restaurant. Growth is lukewarm. I mean, at the end of the day, there's only so much you can do with Cheerios in terms of growth. You can shrink the box a little bit. You can raise the price a little bit, but that's about it. You can't convince more people to eat Cheerios. And newborns or toddlers eat Cheerios, but there's less and less of those to go around. So you got a problem there too. I'm being a little facetious here, but compared to Netflix, General Mills doesn't have a great growth rate. And then something happened. Right about late 2018, they decided to buy a company called Blue Buffalo Pet Foods. So it's called a premium pet food business, but it's sold in grocery stores. It's kind of the same thing as delivering cereal for humans, but you're delivering cereal for pets. But analysts hated the deal. They said they overpaid for it. They took on too much leverage or too much debt. What do they know about pet food anyway? So I like to say there's a lot of bad news priced into the stock back then. So we bought in right around here. It went up again, and then it went down. And it got really washed out in terms of evaluation. And then funny things happened. They ran the business very well. And investors kind of realized maybe they overcooked it on the downside here, and they went back to its mean. And then COVID happened, and a recession happened. And basically that business became something you should respect. And now here we are. So we're probably going to have to trim, if not sell, General Mills. Clearly the valuation is overcooked. And it's unpopular because if you look at your portfolio, General Mills is probably one of the best performing stocks in the U.S. side of the portfolio by far. But reversion to mean is immutable, and one of the ways to protect capital is to sell what's expensive and to buy what is cheap, even at the risk of selling early and buying early. And that's really tough to do. You have to be really ready to look foolish, and we're okay with that. So serial or binge watching. So what I've got here for you is visually, this is General Mills, or Netflix, in orange. That was the price. Call it $350, all the way up to $700. General Mills back in mid-June was, call it $42, mid-40s, and it's call it $80 today. So the stock effectively, let's call it an easy double. It continued to tank and then moved up from there. Don't forget, it also paid a dividend. All the while, Netflix just continued to march forward. And then the overvaluation, and maybe the business is not as good as people thought, like our lemonade stand. If you make a lot of money doing streaming, well, maybe more people want to get into the streaming business, and that's exactly what's going on at the moment. So now the stock is down to 166. So you actually, if you bought at the same time, you'd be down about 35%, whereas you'd be up 85% with General Mills. So like the teen in a school dance with braces on, no one wanted General Mills back then. Everyone wants General Mills, and one could make an argument that no one wants Netflix today, and everyone wanted Netflix a year and a half ago. So for 2022 and beyond, what are we looking at? We're looking at an immutable, dividend-focused strategy. We're looking at quality balance sheet. And when I say dividends, it might also be a share buyback. Personally, I prefer dividends over share buybacks, but I could be talked into making special occasions sometimes for non-dividend paying stocks. Proven management. I want to see, like to see a business that is global. Don't want to overpay for the business. We've gone through that, and we want to stay away from the headlines. That's it. I'm Benoit Padiquin for Exponent Investment Management. Thank you so much for watching. If you have any questions or comments, we would love to hear from you. Don't hesitate and send us an email.